Alright, welcome to topic 6, all about financial instruments under the financial reporting unit. This is part 1 of financial instrument discussion, and the contents are concepts of financial instruments and financial instrument transactions. When you talk about financial instruments, financial instrument is any contract that gives rise to a financial asset of an entity and the financial liability or equity instrument of another entity. That is defined under IAS 32.11. Now we have three main types of financial instruments that we will discuss later on. We have financial asset, financial liability, and equity instrument. For financial asset, we have these characteristics of a financial asset. It can be cash. It is pretty straightforward that cash will be a financial asset. So that includes petty cash, bank accounts, and other cash equivalents that possessed by the company. Another example of financial asset is an equity instrument of another entity. So for example, if you purchase a share from Kina Bank or shares of Kina Bank, BSP, Copper Moly, CPL from stock market, that will be classified under equity instrument of another entity, and it will be considered as financial asset. Another one is if you have a contractual right to receive cash or another financial asset from another entity. Examples of this will be receivables, loans, and purchase bonds to or coming from another entity. And then a contract that will or may be settled in the entity's own equity instrument and is a non-derivative for which the entity is or may be obliged to receive a variable number of the entity's own equity instrument, or a derivative that will or may be settled other than by the exchange of fixed amount of cash or other financial assets for a fixed number of entities' own equity instruments. So these are examples or characteristics to be classified as financial asset. Financial liability is any liability that is a contractual obligation to deliver cash or another financial asset from another entity, which, for example, that will include trade payables, the loans that you obtained, and the debentures or bonds that you had issued. And another one, a contract that will or may be settled in the entity's own equity instrument and is a non-derivative for which an entity is obliged to deliver a variable a number of entities' own equity instrument, or a derivative that will or may be settled other than the exchange of a fixed amount of cash or another financial asset for a fixed number of the entity's own equity instruments. Now, by defining equity instrument under IAS 32.11, it simply states that it will be any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. We have two types of financial instruments. We have primary and derivative financial instruments. Now take note, a derivative financial statements most likely will be attached with or coming from a primary financial instrument. So which means only when there is a primary financial instruments, then we will have derivative financial instruments. So we have examples of primary financial instruments here. We have receivables, payables, equity, securities such as ordinary shares. While we have derivative financial statements, it creates rights and obligation with the effect of transferring one or more of the financial risk inherent in an underlying primary financial instruments. This includes financial options, futures, forward contracts, and interest rate. We will discuss further on this derivative financial statements or instruments when we reach the hedging discussion. Compound financial instruments will have the characteristics of both equity and liability instruments. So example of this is convertible bonds. The convertible bonds are bonds where, or debentures where you can convert it into equity in some future time. Now, recognize a financial asset or a financial liability in the statement of financial position when the entity becomes a party to the contractual provisions of the instrument. So take note, you are not supposed to recognize financial asset or financial liability if you don't have the contractual provisions with regards to that financial instrument. So that is important to take note. Now, with regards to recognition, we have three classifications of financial assets. We have the at amortized cost, at fair value through other comprehensive income, and at fair value through profit or loss statement. Now, this will be really tricky, so you have to be careful, especially when you are recording or recognizing financial asset can fall into the category of at amortized cost if both of the following conditions are met. So the first one is the business model test. You hold financial assets only to collect contractual cash flows. So your intention is when you purchase or obtain financial asset, you want to collect only contractual cash flows. Okay, so which means you are having that investment to receive dividends or interest income. So that's your primary goal why you obtain the financial asset. And then the next one, contractual cash flows characteristics test. The cash flow from the asset are only the payments of principal and interest. So plainly, your intention is to have an investment and receive payments in the form of either principal and interest. So example of this will be debt securities, receivables, loans. Remember our discussion on lease agreement, the lease receivable, where you had lease receivable and you are receiving interest payment and principal payment. Now, financial asset can be under fair value through other comprehensive income if a financial asset meets contractual cash flows characteristics and the business model to collect contractual cash flow. And take note, this is the difference between fair value through other comprehensive income against amortized costs. Here, there's an intention to sell financial asset. So which means this is the main difference between amortized cost and FVOCI. Now, you can voluntarily choose to measure some equity instruments at FVOCI. But if you choose to measure it under FVOCI, there is no more change to be made. Now, if those financial assets will not fall in the previous two category or classification, then all other assets will fall on fair value through profit or loss. So which means any changes will be recorded, gains or loss recorded in profit or loss. While the previous one, fair value OCI, any changes there will be classified under other comprehensive income section. Now for financial liabilities at fair value through profit or loss, okay, these financial liabilities are subsequently measured at fair value, and here all derivatives belong. While other financial liabilities measured at amortized cost, it will be measured using effective interest method. The example of this will be bond or debenture. Now, what will be the initial measurement? So after you recognize, determine if it is under amortized cost, FVOCI or FVTPL. Now you will measure the financial asset or liability, or you have to provide the measurement. So here it says financial assets or liability shall be initially measured at fair value, okay, and fair value plus transaction costs. Now all financial instrument at fair value through profit or loss, of course, will be measured at fair value. But if the financial instrument will be at amortized cost or FVOCI, then the initial measurement will be fair value plus transaction cost. Now, subsequent measurement, again depending on the category. So if it is under, or if it is financial asset, it shall be subsequently measured either at fair value or at amortized cost. Now, financial liabilities are measured at amortized cost unless fair value option is applied. So it's really important for you to determine first what will be the recognition method used for the financial instrument, because it will affect the initial and subsequent measurement. Okay, so let's try this example. On 1st January 2019, ABC Limited issued 3-year bonds with a total face value of 200,000 kina and a coupon interest rate of 10%. So which means that is the interest shown at the face of the bond. The market interest for ABC's bond was 12%. So which means the coupon rate is 10%, but effectively the interest will be 12%. And so the company had to discount the issue price to its fair value of 190,396 kina. So the first requirement is to prepare amortization table. And then afterwards, we will present a sample journal entry for 1st January to 31st December 2019. All right, let us look into the amortization table for bond payable. Okay, so we have the years, and then we have the opening bond payable, that is 190,396 kina, and then the interest payment will be, of course, based on the coupon rate. So the face value of the bond, 200,000 kina, multiplied by 10%. So every year you have to pay 20,000 kina. As an issuer of the bond, you are required to pay the interest. But the effective interest will be the opening bond payable multiplied by 12%. Now the difference between effective interest and then the interest payment made will be the amortization or increase in bond payable. And then the last column here, you will see that the opening bond payable plus increase in bond payable will result to the ending balance of, or closing balance of, bond payable. And then the cycle will go on and on and on. If you can see on the last effective interest charge, that is because only of the rounding off error. So at the end of the period, you must have ending balance of bonds payable 200,000 kina. And then later on, of course, you have to pay the bond outstanding. Now, let us look into the solution or for the journal entry for 2019. So 1st January 2019, you receive payments from bondholder. So debit cash and then credit bond payable at fair value, which is the present value of the bond or the debenture, 190,396 kina. So this is for the initial recognition. Now for the subsequent recognition, you have to do adjustments to ensure that bond payable is still under that present value amount. So we have debit interest expense 22,848, which is based on present value multiplied by effective interest or the market interest. And then credit bond payable, this will increase the bond payable and will adjust the amount of bond payable based on present value. We have credit 2,848. And of course, because you paid the interest, credit cash 20,000 kina. And that ends our presentation. Thank you.